Good morning. You're watching the market right here on ET Now, and it's been monsoon mayhem here in Mumbai. In fact, the entire country. It's water stock in Mumbai's all 7 lakes, which has actually improved quite significantly, and it seems like it's the wettest July we've had ever. Water levels are now reaching up to 58.9%. And this is still Wednesday morning. As per data shared by the BMC, 3 of the 7 lakes in the city are now overflowing. In fact, a red alert has been declared by IMD for part of Thursday, going by which a school holiday has already been declared in Mumbai as well as the Thane regions, and all colleges too will be closed. So heavy rain in Mumbai is what we saw on Wednesday, and it seems like we're headed in for a new July record coming in. So today, right now, it's not all that bad.
But it's been incessant, at least.
School की छुट्टी है.
Yeah,
School
exactly.
की छुट्टी है, हमारा office चालू है. How did your son let you come to office? Didn't he insist?
No, but duty calls. It's just duty which calls.
Yeah.
But yeah, I mean, what takes 15 minutes in the morning took 20 minutes in the morning.
Yeah,
And
it was waterlogged in
what takes me 25, 30 minutes in the evening, yesterday, it took me about 45 minutes.
Yeah.
Luckily, I stay close to office, but the commute, even a 7-8 kilometer commute is something you realize that, oh my God, I mean, when it does not rain, we look up and say, okay, rain, please come.
And now we're craving the sun.
Exactly. So that's what it is all about. Predicting the nature, I think we pretty much know that whatever AI claims we have, whatever mapping we have, but predicting the rain, I think predicting the weather, I think has been almost impossible. The good bit here is that from a market standpoint, which is what we always love to connect anything and everything to stock markets, all the predictions of a subpar monsoon, they in a sense are boomeranged. And typically, when there is high rain, the water levels will go higher, the crop levels will go higher, which means in the second half of the year, once vegetable prices and rice prices and other things they settle down, hopefully vegetable inflation should come down. So that's the only bright way of looking at it. 10 days of pain, but maybe after 15, 20 days, it's going to benefit at least vegetable prices and other things.
Yeah, so that's a good cue. It seems like that's going to at least ease off inflation a little bit. But let's talk markets, and the biggest cue that the markets will be eyeing this morning, the 25 basis rate hike from the Fed Reserve, much anticipated. This is the 11th rate hike in its last 12 meetings, which has now taken the benchmark interest rates to 5.25 to 5.55% band. In his speech, in fact, the Fed chairman Jerome Powell hinted at another rate hike in the upcoming September meeting as well. Many remember in the market were anticipating whether this is going to be the last of the rate hikes or not, amid the central bank's battle against inflation. In fact, let's hear out a soundbite from Jerome Powell. Okay, I think Adrian Movat is here to tell us what he's expecting now from the Fed action and, of course, the market reaction as well. Adrian, hi, morning from a rained-out Mumbai. But tell me, what's the weather looking like for U.S. equities? Given that it's a 25 bips hike, that is something which was anticipated, but another hike in the offing. How do you think the markets are going to perceive that?
I think it's going to be fine for the markets because the backdrop is a robust US consumer and a corporate sector in the United States that's generating good profits. We had a very good numbers out of Meta, the owner of Facebook, this week. So we've got a story here where the top line is a bit better than people were expecting, and the corporate sector in the US has been very good at maintaining margins. And I think it's that micro fundamental that's driving the market higher. So the Fed's got an interesting situation here. We've taken rates up dramatically, but remember, we're taking them up from a 0 level, and that was a dramatic response to a pandemic. And so I wouldn't sort of overstate this. We've moved by 5.25. I'd say really if we were at neutral, we'd have maybe moved by 200 basis points. So I think the Fed is probably in a good position where they'll be able to maintain rates at this high level. The economy's resilience will continue. And I think where there is going to be a surprise in the market is going to be in interest rate expectations. If you look at the interest rate futures, they are assuming very significant cuts next year, which I don't think make any macroeconomic sense. So if you do have trades on that are dependent on the Fed cutting rates, I think you're going to be disappointed. I think bond investors are probably going to lose money with an inverted yield curve. You know, the curve was only more inverted when Volcker in the 1980s was the Fed chairman. And remember, he took rates up to 20%, not 5.5%, which maybe we'll end up going to. So I'm relatively confident on equities, on risk assets like equities, but I am nervous about the assumptions that we get interest rate cuts that are dramatic next year. And I think people are going to lose money in government bonds.
Adrian, another big change has been the US debt ceiling limit. And look, immediately after the debt ceiling limit, US has started their printing press once again. What implications do you think that could have in the second half of this year?
So this is a very important point you bring up. You know, the US is running a fiscal deficit, I think around 5% of GDP. So part of the strength in the US economy is the fiscal impulse that the Biden administration has provided. And so, you know, there is an argument about next year that you won't have the same level of fiscal impulse, and perhaps that might be one of the growth risks for next year. So I think you bring up a very important point in highlighting that the debt ceiling emphasizes that the US government is spending more money than they're bringing in, and that is having a positive effect on demand in the US economy.
Adrian, interest rates, what I've learned over the years is they act like gravity, which is when rates they go higher, stock market should go lower. Either we need to revisit the law of gravity or perhaps reimagine the why stock markets are ignoring interest rates.
Sorry, were you on a holiday in 2022? Equity markets fell dramatically as inflation drove the central bank. So you're absolutely right. You know, when inflation arrives, when it's above the central bank's target, that is very negative for equities because the central bank will have to raise rates, which means lower growth and a higher discount rate. And that's why 2022 was a very, very difficult year for both equity and bond investors. NASDAQ fell dramatically, as did most emerging markets as well. So I think equity markets did their job in discounting the move in interest rates, but they're forward-looking equity markets. And now I think it's going to be a debate between those that think we're having the Fed with rates above 5% for the foreseeable future versus those that are arguing that the economy is more vulnerable and that you're going to get the Fed cutting rates. So I think that's the mindset. Either we're at this level or maybe they're going to go a bit lower.
Good to have you as always. Thanks so much for joining in. How did the US markets react? Well, the Dow Jones continued to inch up for 13 straight days on the trot. S&P 500, NASDAQ were a bit quiet. Asia this morning is in the green. That's the gift Nifty, up 50 points or so. But let's discuss the series gone by. Gosh, it's already been a month. And in the series gone by, you had the Nifty, which has gained about 4.5%. And incidentally, so far at least, it's been the best series of 2023 with the Nifty Bank as well gaining about 5%, Nikunj.
You know, Avan, mathematically...
And then ION expiry as well.
No, I mean, mathematically, yes, 4 series, right? 5 months on the trot, markets have given a positive return. So it's the 5th series where markets have given a positive return. But frankly, if you look at the market from the lens of participation, at least in the F&O market, there is no big bang euphoria. In fact, you know, with this kind of an linear rally, you would imagine that FI and the F&O, the total put-call ratio, the stance of the market in terms of outperforming sectors like banks and all, really from a trader standpoint, they should be massively overbought. But that is not the story. Markets are certainly not obese, and they're certainly not they've not reached that Humpty Dumpty level. Now, mathematically, you know, post July, August, and August could be a lean month because earnings season would be behind us. You pretty much will have to go to macros, and flows actually are not that excellent. So you may say that markets in the month of August should hit a pause button. I think it's too early, Aisha, for anybody to say convincingly that, guys, it's markets have peaked out and it's time to reverse. There's a difference in pause and there is a difference in reversal. All I'm saying is that the market now should logically enter into a pause mode. In a pause mode, you will see distribution, which is select mid-cap stocks will do well, and you will see a lot of volatility. So you got to now see volatility. You're unlikely to see a very sharp reversal. The market is still making higher highs, but it is not really giving you big moves. So the big moves, they are behind us. Volatility should be back, logically speaking, and now you could be in a pause mode. But frankly, I mean, the market has surprised everybody. Even best of the bulls have failed to really kept up the pace, and most of the old timers I've spoken to are some of the best market timers, the real wizards of the Dalal Street, if I may borrow that term. They are also surprised. They're happy, but they are surprised.
Yeah. I think the bigger question, Nikunj, now is what is the strategy going forward? Like you're saying that we are at almost the end of the earnings season. August, you're not going to have anything by way of earnings, so to speak. No major domestic triggers. Global markets this morning are supportive or have been supportive at large. So what do you do now in terms of a portfolio strategy? Obviously, you don't touch your core portfolio.
So, Aisha, that is, I think, this is where your risk management and your psychology should really kick in. The temptation to book profits is very high because market's girne wala. You know how much more it can go. But you don't know how much market will go before it actually peaks out. Where you can maintain a discipline, you could say, look, I will not sell, but I will not commit fresh capital. So don't have the FOMO to invest, to put more money, especially just because you've been behind the curve. And similarly, don't be in a hurry to really sell. Now I'm contradicting myself. You should, if you are bullish, then you should be buying. But no, you don't sell.
Not at these levels.
You don't sell at these levels because markets may just give you another 4-5%. Individual stocks may give you 4-5%. You don't know what the real value of market peak is. We cannot always look at what a Morgan Stanley or a CLSA template is in terms of benchmarking valuations. When we started the year, with all due respect, every brokerage whom we've respected for years had a flat target for Nifty for this year. They had predicted a flat year for the Nifty. But look at where we stand. So don't sell, but don't commit more capital. If you're talking about in sector, I think pharma and autos, they are the ones which are important now.
Okay, pharma and autos, that's what's on Nikunj's radar. Let's find out what's on our chartist radar. Naresh Mirani, Kunal Bothra, they're joining in. And Kunal, just to stretch forward that point that we were talking about, the fact that we have seen that momentum picking up for the frontline indices. Too early to say that we're at some sort of a peak, but there is perhaps more steam left in the rally, you think?
Good morning, Awan. So, well, it seems like because, after 3 or 4 days of consolidation, 300 points gap down, 300 points correction on the index, we've managed to find some good support at the 90,500 to 600 zone. So we preempted the corrective move for the index because the put call ratios and many indicators had become overbought. Now I believe that on the way up, we could probably be now coming back towards retest of the previous highs. And we've seen that phenomena even in the June series or the end of the June series, start of July series, that post a start of a fresh series is where we see the index breaking past about the previous resistance. So hopefully if we repeat the same phenomena, then this time around, start of the August series, which is from Friday, we could probably be expecting the index to cross back above the previous swing highs of 19,990 approximately. So would have a bullish stance on the index, and especially after yesterday's move, indicates that 19,500 is now a good formidable short-term support.
Okay, Naresh, it's expiry day. We've seen a lot of heavyweights that have been propelling the markets up so far. What's your expectation given that it has been a healthy handover, and yesterday we wrapped up the day at above the 19,750 mark?
So we are still in the middle of the range. 19,500, 19,600 is a support. 20,000 is a resistance. We are right bang in the middle of the zone. As well as the problem is we are not seeing leadership coming in a new way. So what we've seen is we saw a new all-time high on ICICI Bank and it just moved up to 3% and is pausing at 1,000 levels. So we are not seeing a follow-up momentum in any of the breakouts per se. So it's a slow and steady move, and this has been the characteristic of this move, wherein We take a pause after say a 400, 800 pointer move. So we are in that pause wherein we should ideally spend at least 2 weeks, and we are not even say 5-7 days as of now in this zone. So we have 2 to 3 weeks to go in this band. And in that period of time, we could continue to see stock specific action. Say yesterday we saw mid cap index make a new all-time high. Day before it was small cap index making a new all-time high. So overall, the momentum is shifting more towards the broader market and stock specific sector rotations. So it's time to focus more on the stocks than on the index till the time we are in this range. Whenever this range breaks below 19,500 or 20,000, that's the time you look back into the heavyweights.
Right. Okay. Let's get stock specific as well. Kunal, what's the bias going to be today?
So towards specific stocks which are showing signs of a fresh breakout or on the verge of a breakout, Bata India is the first stock which I would highlight as a buy. The stock coming back at that 1700 plus mark yesterday. Again, a swing breakout for the stock on the short term basis. So would suggest a buy with 1800 as a target. Stop loss to be kept at 1650. And PVR Inox is the other stock which has done reasonably well in the last 3 to 4 days. The interesting bit in terms of technical charts is the stock coming out of an Ichimoku cloud pattern on the daily time frame, and for the first time I think in the last 6 to 8 months indicates that possibly this could be a near of an end of a major downtrend for PVR Inox. Would suggest a buy 1600 as an immediate target, stop loss at 1470.
Okay, Naresh, let's find out your stock specific strategy. What is it that you're going with today?
So first is a buy on State Bank of India, SBI. Now, if you look at the stock has been facing resistance around 620 to 630 mark, which is the previous all-time high. We saw that move towards 620 2-3 days back also, did a little bit of a dip, but it has started testing that 620 mark. That's generally the first indication of a range breakout to happen going forward. So expecting this range breakout should go towards 675 mark, keeping a stop loss at 600. Second is a buy on ONGC, which has given a cup and handle breakout. Also a 3 to 5 year breakout on dividend adjusted charts. And if you look at the structure, it has been a slow move from 155 to 170.73. Now crossing that 170.73 mark is a big breakout. In this case, it should make a leadership move wherein it could trend much higher in the medium term. So expecting a first target price of 190, stop loss at 168.
Okay. Just let's summarize the market once again, and where do we stand? What's interesting here is that while we may talk about India being really the best game in the world right now, that's not really the story. I think global markets are also in a very sharp uptrend. Whether it started with a comeback in AI stocks, then it moved to some other sectors in terms of themes. And now the rally in S&P and Dow, I think, is also very, very important. So I think, if you frankly ask me, something which I've learned over the years is that markets always bottom out when micros are good. Markets always top out when macros, they turn bad.
And macros are not turning bad.
Macros are not turning bad right now.
Yeah.
Macro involves global. Can macros turn bad? So what are bad macros? For us, bad macros are flows and inflation. It's never growth for us. Macros can turn bad because crude energy prices, vegetable prices, rice prices. I mean, the fact that government has decided not to give rice to ethanol players, they've decided not to export rice. Obviously, you are feeling the pinch there, and there are state elections. So could there be a macro, adjustment there? If globally energy prices they go out of whack because China is opening up, that could be an inflationary scenario which could really have impact on the market. So for me now, the market sell-off will be a function of flows should reverse, which is unlikely, or macro should turn from good to bad, and that also looks unlikely to me. So for me, that really is a trigger point. For the sake of turning bearish, don't turn bearish.
Yeah.
A rally like this rarely comes. If you look at this bout of rally, Kunal, like a 15-20% rally, this is a once in a 3-year phenomenon. It does not happen every 6 months. I mean, you got to really realize that next such a powerful rally is not to come in a hurry, because next year same time markets would be in election mode. So if you're getting a rally, why do you want to be in a hurry to sell?
Yeah. But it's not like it's not going to come in the next 3 years again.
It will. But before,
so for your core portfolio, you could continue holding.
Because there's no news flow which is affecting. That there's nothing negative which is going to happen. IT, the news flow and everything has subsided.
Global markets,
so I think that regards, yeah.
Inflation is not. Typically markets always climb the wall of worry, and that's what they've done this time. How long they can cry? I mean, why do you want to get into this game? When market's expensive, we'll talk about it.
For now, they're not, but a lot of individual stocks which are going to be on our radar.
Yeah, and look who's here in the studios, Anisha. So, Anisha, let's get started. I'm sure there's a lot of earnings triggers as well that are going to keep these stocks in the spotlight.
Yes, earnings is the talk of the town. So let me start with something else because I'm sure you guys have discussed that at length. RBL Bank and M&M, these are the two counters I wanted to discuss to begin with, because there was a very interesting news piece yesterday wherein M&M has taken 3.5% stake when it comes to RBL Bank, and they have said that they could raise it gradually, but it would not go above 10% mark. But the street is a bit worried as to why M&M is going and probably taking an investment into RBL Bank. They're calling it non-core for now, but just a bit of a capital allocation worry. And Nikunj, this has been a worry with the group, right? Last 2 to 3 years, they worked a lot in getting the capital allocation right. But now do you think there could be a bit of overhang with respect to this investment?
See, strategically, does it make sense for them to buy RBL Bank? It's not going to be easy. There is RBI involvement, and can they increase stake beyond 10%? That is subject to a lot of regulatory changes. If they get into a bank which they've tried, I mean, is this the way where they want to get into a bank indirectly and then they have grand plans for Mahindra financials? Looks unlikely. I mean, they would have spelled it out by now. The second question is that at a time when Anisha and his team have done massive work in capital allocation, why are you looking at getting into a bank? You will not stop.
RBL?
Why RBL? See,
The market is going to question why RBL.
yeah, it's a bank where the rate of change is still not very clear. So they'll not stop at 3.5%. They will eventually increase it. So if you're treating this as a treasury operation, why are you treating this as a treasury operation? Because your job is not to run a treasury.
Yeah, exactly.
I mean, there are better options available for Mahindra and Mahindra. So this is, frankly, if you ask me, built like a dampener. This buzz was there in the market, but I'm not been able to connect the dots here. Hopefully, we've been told that they will be coming out with clarification when they come out with numbers. They're in a silent period, so that would be immense curiosity. But sometimes you can wrap around your head around what news is. In this case, if it is in treasury operation, was there a real need to do it? If this is not in treasury operation, is this a strategic kind of an investment which they would like to keep on their balance sheet? I cannot just think around it why. I mean, the management, I'm sure, will give an explanation. It's like saying, when I'm looking at the balance sheet of East India Hotels, ITC had 15% investment in it. They always kept that as a strategic investment. We don't realize it, but there was a point in time, Reliance actually had 5% ownership in Asian Paints. Yeah. Reliance had 5%. Yeah, Reliance had 5% ownership in Asian Paints, and it's only in 2020 they sold. They made almost $1 billion of profit. So could this be one of those investments? I don't know.
Yeah, because they're not opposed to even increasing stake, they said, down the line. So
yeah, up to 10%. But it's interesting whether you're acting like a private equity and taking these bets, specifically because, as even Nikunj said, there's so many other ways to kind of park your treasury money. So why specifically?
And also as a conglomerate, where does it fit? In the group companies, in the scheme of things as a conglomerate, how does RBL
Financial Services
But why is it coming?
They already have.
Yeah, exactly.
So.
Yeah, so now they have probably the aspiration of becoming a bank as well. I mean, right now it's all speculations, but yes, we'll have to wait till August 4th to get more clarity. Till then, this might be a bit of an overhang on the counter. Yesterday as well, we saw that the stock ended towards the lower end of the trading session. But the other one, and this one is an earnings candidate, it's Vedant Fashions. The earnings were rather bleak for a stock which trades at 55 times forward earnings. The same-store sale growth on a year-on-year basis was down as much as 22%. No surprise that revenue was down on a year-on-year basis, and the profitability also took a knock. They have managed to add around 13 stores in the quarter gone by, but nonetheless, they talked about how this was not a seasonally strong quarter. They're hopeful of a recovery in the coming times because last year the base was also on the heavier side. But Nikunj, again the question, why would somebody pay 55, 60 times, which is such a niche player, which is such a seasonal, product?
See, it's a great company, Anisha. You can't take that away from them. I mean, I was just looking at the numbers in the morning and their return on capital. I mean, it's north of 35-40%. So it's a fantastic business, and they can keep on generating, growth, and they're reinvesting cash very sensibly. But I've looked at the experience of, great businesses. When they go through a iota of slowdown, also the massive derating happens. And the classic case here is DMart. It commanded a P multiple of 100. It had gone to 6,000. Now it's at about 4,000, sub 4,000, because the slowdown, I think, was evident. Well, I'm not worried about the margin dropping from 50 to 47. 40% is still very smart, and the return ratios are still very impressive. The only case is that these are stocks which are very niche. These are stocks where promoter holding is 75%, public holding is barely 3-4%, very tightly held by mutual funds. They're stocks which are difficult to call. They will not turn. They are the stocks where you may say that there's a cyclical downturn. I will compromise a bit on valuations, but on a big decline, you want to buy such businesses. Today may not be the right time to buy, but when market goes through a very bad, ugly patch, like we saw, let's say last year, that's the time you want to buy some of these great franchises. See, in India, I've learned over the years, the way to make money, and our viewers, if they're hearing it, please hear it out. The way to make money in India is to buy bad news. When the world is...
Anywhere in the world, not just India.
No, in Europe, you don't buy the bad news because the bad news is bad news in Europe.
Well, I was not even talking Europe, but I was talking, like COVID times, for instance.
Yeah.
So,
But the question that I have, since you're talking about bad time, is the best time to buy? Is that the case for Tech Mahindra? It's really, really bad. It's as bad as it could get.
So, what's the basic
it can't go worse.
I mean, that's the hope we had last quarter as well. And look at it, they surprised us.
So did we from Infi.
See, there is a problem in the business of IT, and within that, Tech Mahindra in a boom time was underperforming. So in a boom time, if you're underperforming, in a slump time, you obviously will feel the heat more, and that's the case here. What we've seen with something like Wipro. But what have market gurus taught us? Whether it's Buffett or whether it is Rakesh, Jhunjhunwala or even Radhakishan Damani, that you have to buy fear. If you buy a company which is going through a temporary disruption or temporary slowdown, that's the time you get the best bargains. So businesses like Vedant Fashions are going through temporary disruption. Indian IT sector is going through a disruption because of AI, which may not be mended. That is my problem. I mean, I don't know how the world would look like. Look at the volatility. Between December and now, Infosys has changed the guidance 3 times. For a company which is implementing AI for others, is struggling to get AI going for themselves.
Okay, there you have it. Thanks, Anisha, for joining in and walking us through those stocks. Let's hear it out then from Ajay Srivastav. We spoke with him just yesterday, and he did talk about that retail space, and he believes that it's one of the most overrated sectors. But paper, on the other hand, is undervalued. What's the rationale? Listen in.
I think the most overrated sector too is retailing, certainly by any chance. Retailing, fashion wear retailing, most overrated sector. General retailing, most overrated sector. You saw the Reliance results. You've seen Trent. You've seen, Avenue you just spoke about. Just see their performances versus what the market valuations are. I think the most overrated sector, in my view, at this point of time, among all the sectors that I see in India. And I think if you were to look at what is really the underrated sector, nobody buys it. I do not know why. Paper. P's of 3 and 5, incredible. Even after this expansion, highly profitable companies, 3 or 4 companies run this whole market in India, and the P's are less than 5. I have not seen this. I do not know why it is so, and it has continued for year after year. It's not like it's a one-time phenomenon. I have no clue. I'm sorry to say why it is happening there, but you ask me what's the most underrated sectors, paper, P of less than 5, highly profitable, duopoly, literally, no competition, necessary of life, but still the P is 5. Such as market, fashion retailing gets P of 120, essential profitable business of paper gets a P of 5. That's market, my friend.
Well, DRL, that's the one which is going to be in focus this morning, saw a jump in its net income as well as the top line, beating analyst estimates on all counts. In fact, the U.S. generic business as well grew 26% sequentially. Also, Cipla is the other one as well, which reported a strong first quarter, net income coming in at almost 1,000 crore rupees. Revenues as well saw a decent jump coming in at about 6,000 crore rupees. And both the India as well as North America region sales came in at a combined 2,000 crore rupees and $200 million respectively, actually. So let's hear out both these pharmaceutical managements.
There is an improvement. There is certain moderation in the price erosion. The model is the same. Price erosion is still there, but relatively to the past, it's much more moderate than it used to be.
Okay, so there has been an improvement, but Mr. Israeli, what we understand that in the US markets, what's also working is that the drug shortages are at a record high level. So how much of the price erosion are we seeing in the US generic business given the shortages across the dosage form, and what's the outlook going ahead on that front as well?
Indeed, there is a 15 to 20% of the SKU, I'm talking numbers of SKU, is in certain, let's so-called supply challenges, not necessarily a shortage, And this is a very important task for all of us to try to address it as the patient nears the products. And obviously, this is what we are doing. Generally, the signs we are getting from the market is that because of the shortages and because of a large section of the market finding new homes. For example, a lot of US companies have been on sale or have gone bankrupt. I think the supply-demand side of the equation is readjusting or rebalancing, as a result of which the pricing pressure has moderated a bit. Going forward, I think, over the real impact of this moderation will probably be felt more in the next 6 to 9 months. At our current facility, which is Indore, we will launch and, within a week of when we are cleared. If we are not cleared to launch from Indore, then the process where our facility is getting ready, the batches get transferred, this launch is definitely out by about a year. Right. But having said that, we've already started working towards it, and some portion of that year has gone as we speak. So it will probably be a year out if Indore is not cleared. If Indore is cleared, it will be an almost immediate launch.
That's the plan, Dr. Reddy's for you. We'll be watching out for those two stocks in trade. But REC as well in the spotlight. They've raised $750 million from green funds as against a target of $500 million. That's the word coming in from the CMD, Vivek Kumar Devgan. Let's listen in as he talks about the company's projects going forward.
We had intended to raise only about $500 million through green bonds, but keeping in the tremendous response which we have received from the foreign investors, we raised $750 million US. We hope that going forward, since we are targeting to finance green projects worth about 3 lakh crore in next 7 years, there will be huge interest from pension fund, from insurance fund, sovereign wealth fund. A lot of investors are already have reposed faith in REC and financing our green projects.
So what are your international fundraise plans for the coming financial year?
We are raising the foreign currency borrowing, which is much cheaper as compared to the domestic borrowing. We are also targeting to raise external commercial borrowing in Japanese yen, euro. Recently, withholding tax has increased, but if we raise external commercial borrowing through yen, it will be still beneficial. And in addition to that, REC is in the process of opening a subsidiary in Gift City at Gandhinagar. There will be able to borrow in terms of dollar and will also be able to lend in dollar term. That will give a big comfort to our developers and those who are importing equipment and or exporting their product.
Okay, lots more earnings to talk about in Bajaj Finance, even though the numbers came in at the fag end of the market hours. But let's take it across to Vamakshi and take stock of the important commentary which came by from the management in their conference call. Vamakshi?
Well, yes, let me first take you through the guidance update that has come in from Bajaj Finance. Now, FY24 AUM growth was expected at 28 to 29% earlier. The company has upgraded it to 29 to 31% on a year-on-year basis. Other than that, when we look at the long-term AUM as well as the profit growth guidance, that has been maintained, but they're expecting better asset quality metrics over the long term. Other than that, when we look at the ROA as well as the ROE, the company has also upgraded its guidance out here. ROE is now expected to come in the range of 4.6% to 4.8%, while ROE is expected in the range of 21 to 23% over the long term. Let's quickly look at the key commentary that came in from the management during the con call. Bajaj Finance management highlighted that it was an excellent quarter for the company. They're expecting to see a run rate of new loans of nearly 10 million per quarter. Cost of funds have definitely inched up. They're expecting a moderation in the NIMs going ahead. In fact, they're expecting to see 10 to 15 basis points of contraction over the next 2 quarters each. However, in FY24, they're hopeful to see a reversal. Now, risk metrics across all businesses they highlighted was strong except for the rural B2C, and over here they've tightened their credit standard. On the OPEX front, they have highlighted that their OPEX has peaked down. They will continue to, however, increase their investment in their digital ecosystem, and they also expect the operating leverage to see play out over the next few quarters. So all in all, the positive commentary is coming in from Bajaj Finance, and on the back of that, watch out for discounter.
All right, lots lined up today on the show. Let's get straight to it. It's been nothing short of a weak set of numbers when it comes to Tech Mahindra. Mohit Joshi, MD and CEO designate at Tech Mahindra, as well as CP Gurnani, MD and CEO, along with Rohit Anand, CFO, Tech Mahindra, are with us to discuss the quarterly performance gone by and what the road ahead is. Is this perhaps the worst now behind us? Mr. Gurnani, I'm going to begin with you then first. You said that it has been one of the toughest. It has been one of the most challenging quarters, as you've put it. But is this actually the worst? Or the question is the pain going to continue for, say, even a couple of more quarters?
Through all these interactions, you definitely know that I strongly believe that we have an opportunity to improve from where we are. That opportunity to improve comes from 4 facts. Number 1 is our people investments. Number 2, technology investments. Number 3, deep relationship with the customers. And number 4 is that our investments in communications and in AI will create better solutions for the market. So I think it is a situation where some of our verticals are slowing down, and they're slowing down because they need to repurpose themselves. It's not that they are going to slow down forever. So that's why I remain optimistic, and I'm very sure that we will see a recovery.
Okay, Mohit, let me get in your take as well, because your first conversation with us as the CEO designate. So congratulations. Tell us what are going to be the key priorities for Tech Mahindra, because you've toured India, you've toured the globe extensively over the last few weeks. What have client conversations really been like?
So look, I think it's been slightly over a month since I joined, and as you mentioned, most of the time I've spent in trying to get up to speed, to listen, to learn, and to meet with the teams and to meet with the clients, right? So the first set of pit stops were in India, visiting our largest centers, doing town halls, getting a sense of the culture of the organization. But then after that, I've been here in Europe and in the US, meeting up with a number of our largest clients. And I think a couple of things have struck me, right? The first is that this is a very strong company. And I realize it even more so after being inside, that the strengths of the relationships with the employees and the strength of the relationship with the client is really quite profound. So very heartened to see the strength of the company in action. I think the second thing is that we're in a very attractive industry. The service lines really have, seen a level of investment and a level of thought leadership, where I'm quite comfortable that our service lines are world-beating. And thirdly, this has been a challenging quarter, but in the medium to long run, I'm very confident of the capabilities of the company, the strength of the relationships. So clearly, there is work to do. CP and I, over the next 5 to 6 months of the transition, are going to be working on a plan, and we will execute on the plan, and hopefully by that time the economic environment starts to change as well.
Right, Rohit, very bleak margins this quarter though, but do you see them hitting double digit by year end?
Can talk about the levers and what's driving the current quarter margin instead of giving guidance. So when you look at 6.8% drop, 440 basis point quarter over quarter, 50 basis point of that is driven by Comviva seasonality. There's a drop in revenue that is causing broadly 2% margin drop, while we do reduce the cost associated, but there's a mismatch there. So that's the 2%. And then there's 2% that is driven by certain one-timers in the quarter, based on certain client situation around bankruptcy announcements. We've taken on a conservative basis provisions in our books, and that's causing a one-time in the quarter, reducing the margin by 200 basis point, right? So that's kind of where the drop is for the current quarter in terms of drivers. As you look forward, I think for us, there's a tremendous room of opportunity on driving operating improvement on various metrics. And as we've articulated in the past, we still have headroom on subcon cost reduction, which we've reduced from 16% of revenue to 14%. We'll continue to drive it even further down. We have an opportunity of improving on our pyramid rationalization. We've inducted freshers in the past. We'll continue to drive that in the future, making sure we get some cost benefit there. Overall on levers around offshoring and divestment that we'd also mentioned of non-strategic assets. So as we get through the year, I think those are the actions we'll execute and continue to drive improvement from where we are towards the fourth quarter of this year.
Okay. So Rohit, given that this quarter was affected by seasonality and one-time expense, fair to say that this is the bottom for margins?
Yes.
Mr. Gurnani, I like your emphatic yes, or rather Rohit's. But, deal wins, Mr. Gurnani, were also muted this quarter. You see yourself getting back to $700 million to about $1 billion a quarter run rate anytime soon?
If I were to answer like Rohit, I would have said all of above. But personally, I am little encouraged because the overall deal pipeline is very strong. And all the change that I've noticed is earlier in my planning, I used to take a forecasted date of closure plus minus 1 quarter. I think because of certain uncertainties in the market or certain sectorial uncertainties, now it is plus minus 2 quarters. So, I would still say that I think the value proposition of cost transformation, value proposition of technology transformation, value proposition of business transformation is very strong. And hence, I would consider this as a temporary blip in terms of large deal performance, but overall confident that it will come back.
Right. Rohit, when do you expect a recovery then? And will FY24 be a year of 2 to 3% growth, flat or decline further?
Yeah, so again, as we've articulated, we don't give a guidance, but I can tell you directionally the way we're thinking, right? And we said that before. Our first half, as we'd articulated before, would be challenging, and that's what it's turning out to be based on the macro environment. And 1Q a little bit more than we anticipated. And the view continues to be for us from a first half perspective, and we assume right now improvement based on certain client discussions and the quality of those discussions, that then improvement will likely to happen as we move into the second half. But given the volatility of the situation and the environment we're in, we'll have to be closely monitoring and updating all the stakeholders as we move forward between now to heading into the second.
Right. Okay, gentlemen, great to have you all on the show. Thanks for taking the time out and highlighting the numbers. Tech Mahindra missed the already muted expectations, so this is going to be a stock to look out for. Of course, the bigger question is whether the market has already digested that after the hit and the shocker that came by from Infosys or not. Let's see which way Tech Mahindra heads. But that said, let me welcome on board Hemang Jani as well. Lots to talk about with him. But Hemang, firstly, this news coming in from the stable of M&M, the fact that they've acquired this 3.5% stake in RBL Bank, what do you make of that?
So good morning, Aisha. I think, definitely it's a big headline, but I think if you look at the extent of the stake and the amount that is, gone out, about 400 odd crore, it doesn't really make too much of sense because time and again, Bajaj Finance has very clearly expressed that they are not looking to convert this company into a bank. They are happy with the NBFC structure at the moment. So it's not very clear as to what is the strategic, thought process behind acquiring such a small stake. Is it going to be just an investment, or there are any further plans to really, down the line get into the banking business per se? So I think maybe because of this news, you might see some action in the RBL Bank. But I don't really think that there's a case for too much of development in terms of banks, etc. So I think maybe if you see another maybe 5-7% kind of an uptick, it would be good to kind of get out of RBL Bank.
There when it comes to M&M and RBL Bank. We'll get those answered. But for now, let's find out which are the stocks on the editor's radar. Today, we're putting the spotlight on the entire pharma sector and talk about the big triggers, the India business, the commentary, and even the kind of valuations that some of these companies command.
See, from a sunrise go-go setup in 2020 because of COVID to a very stormy environment, looks like the darkest dusk before the dawn is over for the pharma sector, especially the US generic companies. Again, it's going to be very case specific, but you look at initial companies, and since Dr. Reddy has a very large presence there, I would look at Dr. Reddy's numbers. The US commentary, I think, is positive. Even from Cipla, they don't have a formidable business there. They've been a late entrant. They're not even $1 billion for Cipla in terms of the US generic market. But the categories in which they are in, especially the inhaler or respiratory category, things are looking up now. What has changed in US? Well, it's a cycle, Avan. There was a capacity expansion because of COVID. Then there was a crunch in the generic market. And now there is a demand which is making a comeback. It's a cycle. Pharma companies also follow a cycle. Price erosion has been much lower, and there is a bit of a channel reconfiguration. So I will not be surprised that pharma selectively comes into an outperformance mode now. If you're looking for a sector like we looked for a sector in December, we spoke about autos, they are looking good. I think pharma now, let's say 80% of pharma stocks have underperformed. I would not be surprised that if 50-60% of pharma stocks in the second half of this year, they start outperforming, given that commodity prices are also coming back. Also, please remember, domestic market.
Yeah, that's
cold, flu, dengue, water, rain, cough syrups, OTC drugs. Any company which has got a very strong presence in the OTC market in India, a company like Cipla, given the seasonality what we've had this year, extended long summer, extended monsoon, more focus in terms of healthcare, the domestic market focused companies are going to be strong. So for me, a company like Cipla will be a standout name. It's a combination of US generic as well as domestic market. The valuations for some of the pharma companies, if you frankly ask me, they are not that cheap. So the relative outperformance...
Never have been really.
Yeah, so in terms of an valuation comfort, I think it's not there, but in terms of a trend there, I think the trend is better.
Trend is looking good, perhaps no valuation comfort, and it's going to be a case-by-case basis, Aisha. That's the editor's take.
Okay, that's that on the pharma sector. Hemang, you want to give your thoughts on DRL and Cipla?
So clearly, a strong beat in earnings, both for Dr. Reddy's and Cipla. And what is really, important in terms of development or trend is that there is an uptick in the North American base business. Okay, so that is something that the market was keenly watching out. And clearly, both Dr. Reddy and Cipla have given out indication that things are getting better. In terms of Dr. Reddy's, we think that the management commentary also has been quite encouraging. The gross margin at 56 to 59%. And the fact that excluding Revlimid, there's a robust growth across with a market share gain. So I think there's a case for some sort of action across some of these names like Dr. Reddy, Cipla and Sun Pharma. I think at least in the near term, you would see a good amount of outperformance come through.
Okay, that's the take coming in on the pharma space. Axis Bank, that's also something that the street is going to be reacting to. Hemang, quite surprising. The NIMs are the lowest in the last 3 quarters, and the operating profit as well has seen a decline sequentially, and for a second straight quarter.
Right. So I think some disappointment, in terms of the, overall operating performance. Large part of the, the profit after tax has been driven by the other income. The NII growth was very healthy. The loan growth was also healthy at 22%. But, there is a sense that compared to some of the other banks like ICICI Bank or IndusInd Bank, or to some extent HDFC Bank, Axis numbers have not been that great. And margins have been, an area where there is a certain amount of disappointment. So we think that post these numbers, you might see a little bit of subdued performance by Axis, but I don't see a reason for a significant correction in this name at this point.
Nuresh, how did you forget Adani Group of stocks? They've done very well.
So difficult place to trade because the volatility has been all over the place. So if you look at Adani Enterprises, the stock has been making moves around this 2400, 2500 mark, not able to sustain in a big way. So out here, my view is to avoid, the only name which looks interesting is ACC and Ambuja Cements, which have again given a fresh breakout. So that is where there could be upside. Watching out for Adani Ports because that's the one stock which has actually come back all the way to the price where it started falling from. So the gap down where it started was from at 750, 760. In the recovery over the last 3 months, it has made quite a few attempts around that 750, 760 mark. So the only name in the group which has actually turned around totally has been Adani Ports. So I would be watching out for Adani Ports and Ambuja Cements only.
Hemang, we were just highlighting Vedant Fashion's numbers and, just looking at how the same-store sales, etc. performance has been. That kind of falls short of the valuations that the stock quotes at. I mean, the margins have come in at 47.5%. While standalone, they may be okay, but in the same quarter last year, they did over 50%. The PAT has come in at 92 odd crore rupees. The revenues have come in a little lower by about 4%. It seems like it was, not the most profitable quarter for them.
Absolutely. The fact that, there is a 4% kind of a decline in the revenue and even on many other parameters, whether you look at sales to customers or footprint addition in this quarter or revenue per square feet, there is a definite amount of disappointment. I think partly it is because of the shorter wedding season, but we think that some of these companies are overhyped, because of their focus on a certain niche category and the fact that that market could expand in a big way. But I think at these valuations and given that the numbers are not really delivered, there is going to be some amount of de-rating when it comes to Vedant Fashion.
Okay, that's going to be one key stock to look out for. And the markets near life highs. Ace investors are now rejigging their portfolios. What are they buying? What are they selling? Sharad, as always, has been tracking that and he joins us with two other smart portfolios this morning. Sharad?
Well, yes, in focus we are having Radhakishan Damani and Vijay Kedia's portfolio and how they have changed, especially the important stocks for the June quarter. Now, do remember there has been no new entries coming in Radhakishan Damani's portfolio, but there has been a likely exit or a stake has actually gone below 1% and there are 3 stocks over here. Firstly is Andhra Paper, where he had a stake of almost 1.26% in the month of March itself. And the paper industries itself, this quarter, we have seen that the demand levels have still sustained. And importantly, the work from home actually coming in from the office has actually increased the demand for paper. So that is something interesting to watch out for in the paper segment. And Astra Microwave, a defense name, the stock has a good run-up as well. And over here, we might have seen profit booking also amongst marquee investors. And lastly, there was a complete exit coming in for Sundaram Finance. Up next, we are having the portfolio of Vijay Kedia. And over here, there has not been a very significant, no new entries coming in, but a likely exit has come in for Ramco Systems. And this is for the 5th straight quarter that he has been reducing stake in the company itself. And do remember, the returns have been quite dismal over the last 1 year itself. And so that is something important to track for. But the question remains is which are the 3 important companies where his stake has increased the most. First and most importantly is Atul Auto, and over here the stake has increased by 653 basis points. And do remember, this is the conversion of the preferential allotment which was there for Atul Auto. And of course, the buzz is coming strong in the EV space as well. Apart from this, even for Patel Engineering, there has been an important increase coming in his stake when it comes to the infra stocks. And lastly, Precision Camshaft. Over here also there has been an 11 basis points hike. And do remember, the auto ancillary space is also buzzing because of the EV theme.
All right, Vijay Kedia and RKD, Radhakishan Damani, the owner of DMart, one of the most legendary investors I think the world has ever seen. Completely unassuming, very, very recluse, rarely, is seen in public. But I mean, what a style he's followed in terms of buy and hold, and his ability to look at the big picture, hold on to some of those stocks for years, sweat it out, digest the volatility is what makes you from an unknown investor to an unforgettable investor. That's Vijay Kedia for you. Again, very smart, great friend of our channel, keeps on coming regularly. But Atul Auto now he owns about 15%. This is second league, the second innings in Atul Auto, because in 2007-8 he'd invested in Atul Auto. The stock hit out of the park, and now I think he's entered again largely because of that entire play on what is happening in CV. So Himang Jani, if Sharad had to do a link on Himang Jani's smart portfolio, what will that name be? One or two stocks you've added in the quarter gone by.
So Nikunj, my largest bet is National Stock Exchange. I think it's not listed as yet, but given the way things have really moved on the turnover front and the gift Nifty being operational, clocking high volumes, I think it's just a matter of time when the NSE hits the IPO. But this is one name where I think it's a no-brainer. Like, if you look at the top Nifty 50 companies, you will hardly find 2 or 3 companies where there is a consistent growth of 25-30%, a lot of unlocking. So I think the current price is around 3,100 or thereabouts. There were few large blocks that have happened. I have been a buyer in the stock, and I think there's a long way to go.
Right. Okay. Hemang, stay with us. Going to quickly come back to you, but after this very short break.